I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. The Little Book of Commodity Investing by John Stephenson is a concise guide that provides an overview of commodity investing. Stephenson explains that commodities are the raw materials that are used to produce everything around us, and investing in commodities can be an effective way to protect against inflation and diversify an investment portfolio. The book is written in a conversational style and is easy to read, making it accessible to both novice and experienced investors. The book is divided into 9 chapters, each of which covers a different aspect of commodity investing. In the first chapter, Stephenson provides an introduction to commodities and explains their importance in the global economy. He also identifies the types of commodities that investors can trade in and the various ways to invest in them. The second chapter focuses on supply and demand dynamics that influence commodity prices. Stephenson examines the factors that impact the supply and demand of commodities, including geopolitical events, weather patterns, and economic growth. He also explains how these factors can impact prices and provides examples of how the supply and demand dynamics have played out historically. In the third chapter, the author highlights the role of commodities in a diversified investment portfolio. He explains how commodities perform differently from traditional asset classes such as stocks and bonds, and how they can provide a hedge against inflation. Stephenson provides strategies for investors to incorporate commodities into their portfolios, using both passive and active approaches. The fourth chapter provides an overview of commodity futures and exchange-traded funds, ETFs, which are 2 of the most popular ways for investors to gain exposure to commodities. Stephenson explains how commodity futures work, how to trade them, and the risks associated with them. He also explores different types of ETFs that track commodity prices and provides guidance on how to select the right ETFs for your investment goals. The 5th chapter assesses the risks and rewards of investing in specific commodities. Stephenson examines the market dynamics of various commodities, including oil, gold, copper, and agricultural commodities. He explains the factors that drive the price of each commodity and provides insights into how to invest in each one effectively. In the 6th chapter, the author discusses the role of commodities in a globalized economy. He explains how emerging markets are changing the landscape of commodity demand and how investors can leverage this trend to their advantage. The 7th chapter examines the risks associated with commodity investing. Stephenson emphasizes the importance of due diligence and risk management in commodity investing. He also discusses the risks associated with each type of investment strategy and provides guidance on how to manage these risks effectively. The 8th chapter looks at the future of commodity investing. Stephenson explores the impact of technological advances and environmental concerns on the commodity market and discusses how these trends will shape the market in the coming years. He also provides guidance on how to position your portfolio to take advantage of emerging trends. In the final chapter, the author summarizes the key concepts of commodity investing and provides a checklist for investors to follow when considering investing in commodities. He also outlines his outlook for commodity prices in the near and long term. Overall, The Little Book of Commodity Investing is an informative and accessible guide to investing in commodities. Stephenson's conversational writing style and clear explanations make this book an ideal resource for anyone looking to diversify their portfolio and protect against inflation. The first main point of The Little Book of Commodity Investing is that commodities are an important part of the global economy, and investing in commodities can provide diversification and help protect against inflation. The author, John Stephenson, explains that commodities are the raw materials that are used to create everything from food to cars to buildings. Commodities can be classified into 4 broad categories: energy, metals, agriculture, and livestock. Stephenson argues that investing in commodities can provide diversification benefits for investors. Traditional asset classes like stocks and bonds can be highly correlated, meaning they tend to move in the same direction at the same time. In contrast, commodities often behave differently from traditional assets and can provide a hedge against inflation. When inflation rises, the prices of commodities usually rise as well, which can help protect investors' purchasing power. Moreover, the author highlights that commodities have a low correlation with other investment classes, providing a valuable source of diversification and reducing the overall risk of an investment portfolio. This low correlation can help investors to spread their risks, leading to a more balanced and stable portfolio, which can outperform over the long term. Additionally, the author discusses how investing in commodities provides direct exposure to physical assets, unlike stocks or bonds that are merely paper assets. The prices of commodities are determined by global supply and demand dynamics, which investors can observe and react to. Finally, Stephenson emphasizes that investing in commodities requires a long-term perspective and investor patience. Due to the unique characteristics of commodity markets, like their sensitivity to supply and demand factors, it is recommended to hold commodity investments over several years. Overall, the first point made by Stephenson stresses the importance of commodities, their role in the global economy, and how they can benefit investors through diversification, inflation protection, direct exposure to physical assets, and potential long-term returns. The second main point of the Little Book of Commodity Investing is that the pricing of commodities is influenced by a variety of factors, including global supply and demand, geopolitical events, and weather patterns. The author, John Stephenson, explains that commodity prices are determined by the forces of supply and demand, which are constantly fluctuating due to a range of factors that affect the market. First, Stephenson highlights the importance of global supply and demand factors in determining commodity prices. Global demand for commodities is affected by factors such as demographic trends, economic growth, and technological advancements. On the supply side, the availability of natural resources, production limitations, and infrastructure constraints can impact commodity prices. For example, increased demand for oil may lead to higher prices if supply is constrained due to geopolitical events or production limitations in oil-producing countries. Second, the author discusses the impact of geopolitical events on commodity prices. Examples include trade disputes between countries, wars and conflicts, and government policies that affect commodity markets. Such events can create uncertainty and volatility in commodity markets and lead to changes in supply and demand dynamics and ultimately impact commodity prices. Third, weather patterns and natural disasters are other factors that can impact commodity prices. Changes in climate patterns can have an impact on crop yields and livestock production, leading to fluctuations in the prices of agricultural commodities. Furthermore, natural disasters like hurricanes and floods can disrupt transportation and production, leading to changes in supply and demand. Overall, the second main point highlights that the prices of commodities are subject to a range of factors, including supply and demand dynamics, geopolitical events, and weather patterns. These factors can all have a significant impact on commodity prices and can create volatility in commodity markets. Investors who understand these factors and how they impact commodity prices can make informed investment decisions and take advantage of market opportunities. The importance of keeping abreast of the latest news and market developments cannot be overstated, and it is important for investors to carefully consider the factors that influence commodity prices before making an investment decision. The third main point of the Little Book of Commodity Investing is the role of commodities in a diversified investment portfolio. The author, John Stephenson, emphasizes that commodities can provide diversification benefits, help protect against inflation, and improve overall portfolio returns. Firstly, Stephenson explains that commodities can provide diversification benefits since they often move independently from other asset classes like stocks and bonds. This creates an opportunity for investors to spread their risks and achieve a more balanced and stable portfolio. The author cautions that a well-diversified portfolio should include a mix of asset classes, including commodities, to ensure that the portfolio is not exposed to the risks of a single asset class. Secondly, Stephenson states that investing in commodities can help protect against inflation. An increase in inflation can erode the purchasing power of an investor's portfolio, but commodities tend to perform well during periods of inflation. Since commodity prices are often closely tied to inflation, if inflation increases, so does the price of commodities, which can help preserve the value of an investor's portfolio. Thirdly, the author provides several strategies for incorporating commodities into a diversified investment portfolio. For instance, investors can invest directly in commodity futures or exchange-traded funds, ETFs, that track the prices of commodities. Alternatively, they can invest in commodity-related stocks or mutual funds, which can provide indirect exposure to commodity prices. Finally, Stephenson discusses the importance of asset allocation and rebalancing in a diversified portfolio that includes commodities. He explains that asset allocation is the process of dividing an investment portfolio among different asset classes, while rebalancing involves adjusting the portfolio's allocation periodically to maintain a desired level of risk and return. Stephenson suggests that investors should review their asset allocation and rebalance their portfolios periodically to ensure that they remain aligned with their investment goals and risk tolerance. In summary, the third main point of the book emphasizes that commodities can play an essential role in a diversified investment portfolio. They can provide diversification benefits, protect against inflation, and improve overall portfolio returns. The author provides several strategies for incorporating commodities into an investment portfolio and emphasizes the importance of regular asset allocation and rebalancing. The fourth main point of the little book of commodity investing is the overview of the different ways to invest in commodities, including physical commodities, commodity futures, and exchange-traded funds, ETFs. The author, John Stephenson, explains the advantages and disadvantages of each investment type. Firstly, Stephenson discusses investing in physical commodities such as gold, silver, or oil. Investing in physical commodities requires purchasing the actual commodity and storing it in a secure location. While investing in physical commodities provides direct exposure to the commodity and eliminates counterparty risk, it requires significant storage and insurance costs, which can reduce returns. Moreover, it can be challenging to find buyers when selling the commodity. Secondly, the author explains investing in commodity futures. Futures contracts are agreements to buy or sell a commodity at a set price at a future date. Futures contracts can provide investors with exposure to a commodity without the need to own or store the physical commodity. However, futures contracts can be complex and highly volatile, making them challenging for individual investors. Moreover, futures contracts require a margin account, which can amplify losses. Finally, Stephenson explains investing in ETFs that track the prices of commodities. ETFs are a diversified and low-cost way to invest in commodities. ETFs also provide the flexibility to trade the commodity without requiring storage or delivery of the physical commodity. However, ETFs may not provide a direct exposure to the commodity, and the prices of ETFs can deviate from the underlying commodity prices due to market factors such as liquidity and management fees. Overall, the fourth main point of the book provides an excellent overview of the different ways to invest in commodities. It underscores that each investment type has its advantages and disadvantages, and that investors must weigh these factors when selecting an investment. In addition, the point highlights that investing in commodities requires a long-term perspective and careful consideration of all the risks and costs involved. The fifth and final main point of the little book of commodity investing is to understand the risks of investing in commodities. John Stephenson emphasizes the importance of being aware of both the potential benefits and risks involved in these types of investments. Firstly, Stephenson explains that commodity prices are highly volatile and subject to significant fluctuations due to market and economic factors. Economic and geopolitical events can cause changes in supply and demand for commodities, which can lead to sudden and significant price movements. Secondly, commodity investments can be impacted by market liquidity and trading volumes. This can make it challenging to enter or exit a position quickly, especially for individual investors. Thirdly, investing in commodity futures requires a margin account, which can amplify losses if a position moves against an investor. These losses can be significant if an investor is not careful and does not manage their risks correctly. Fourthly, investing in physical commodities requires storage and insurance costs, which can eat into returns and create additional risk. Finally, Stephenson stresses the importance of diversifying investments in different asset classes, including stocks, bonds, and cash, to spread risks and reduce the impact of potential losses. Overall, the fifth main point of the book highlights the risks involved in commodities investing and emphasizes the importance of managing these risks carefully. Investing in commodities requires a long-term perspective, a deep understanding of the market, and careful consideration of all the risks and costs involved. By understanding both the potential benefits and risks of commodities investing, investors can make informed investment decisions and achieve their long-term investment goals. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.